The American Express Corporate Purchasing Card, commonly known as a P card, serves as a specialized B2B procurement tool designed specifically for mid to high volume business spending within large or global enterprises. Unlike the more common corporate green or gold cards, which prioritize travel and entertainment expenses for employees, this specific card targets operational costs like office supplies, utilities, professional services, and maintenance or repair. It functions as a replacement for the often cumbersome request for quote and purchase order processes that can bog down a procurement department. One of the most immediate benefits is the absence of an annual fee, as it is billed at $0 to the card member account. This card operates under corporate liability, meaning the company itself is responsible for all payments rather than the individual cardholder. Because it is a charge card, the expectation is to pay in full, though it offers a significant financial cushion with up to 51 days of interest-free credit from the date of purchase. When looking at the financial mechanics, it is important to note the 2.5% foreign transaction fee, which can add up quickly for organizations dealing with a global supply chain. If a payment is missed, the late fees are quite substantial, being either $29 or 2.99% of the past due amount, whichever happens to be greater. To manage these expenses, the tool utilizes reporting systems like American Express at Work and Corporate Account Reconciliation, also known as CAR. These systems allow for direct data feeds into major enterprise resource planning software such as SAP, Oracle, and Concur. This level of integration is a major selling point for finance teams looking to streamline their end-of-month reconciliation processes and eliminate the manual entry of data. The primary strength of the purchasing card lies in its granular spending controls. Program administrators have the power to set specific limits per transaction, per day, or per month for every card issued. A standout feature is merchant category code blocking, which allows a company to restrict where the card is used. This effectively prevents employees from using a procurement tool for unauthorized purchases like restaurants or retail stores, while still permitting transactions with industrial suppliers. This level of control addresses the major pain point of maverick spending, where employees go off script with company funds. By consolidating thousands of small, one-off supplier payments into a single monthly payment to American Express, procurement teams can save hundreds of administrative hours that would otherwise be spent processing individual invoices and checks. Beyond the administrative savings, the cash flow benefits are a significant draw. The 51-day float allows businesses to keep their cash and interest-bearing accounts for nearly 2 months while still satisfying their vendors. Furthermore, the data visibility provided by the corporate account reconciliation tool is highly sophisticated. It offers level 3 data, which provides detailed line item descriptions of exactly what was purchased. This is an invaluable resource for tax compliance, auditing, and general financial transparency. Security is also a top priority, as American Express maintains low fraud rates and includes protections like the Global Assist Hotline and Purchase Protection. This coverage protects eligible items against accidental damage or theft for up to 90 days from the purchase date. However, there are several drawbacks that a business must weigh against these benefits. First and foremost is the complete lack of individual rewards. While cards like the Corporate Gold or Platinum offer membership rewards points to the person using the card, the purchasing card is strictly a utility tool. Companies might occasionally negotiate a volume rebate or cashback based on their specific contract, but this is not a standard feature. For an employee, there is no personal perk to using this card. The high foreign transaction fee of 2.5% is another significant hurdle for companies that source materials internationally. Those fees can easily wipe out the administrative savings gained from using the card in the first place. Implementation is another area where a company must be prepared to invest time and resources. This is not a product that works instantly out of the box. To achieve full integration with ERP systems and access detailed level 3 data, There's a necessary setup phase that requires coordination between IT, finance, and procurement departments. It is a strategic commitment rather than a simple plastic solution. Additionally, the strict corporate responsibility means the company carries all the risk for charges made on the card. While there are commercial waiver protections to help with employee misuse, the burden of monitoring a large-scale program is significant. Because this is a pay-in-full card, it offers no flexibility to carry a balance, making it a poor choice for a company facing a temporary cash flow shortage. This card is generally the right choice for mid to large enterprises with at least 10 employees and an annual tail spend of $250,000 or more. It is ideal for those who want to eliminate out-of-policy purchases at the point of sale, and for those who use accounting software like SAP or Concur to automate their month-end tasks. Conversely, it is not the right tool for businesses seeking travel perks like lounge access or hotel upgrades, nor is it suitable for small businesses that lack a dedicated procurement team. For smaller operations, a business gold card might offer better value through rewards. Those needing to finance purchases over several months should instead look for a credit card with an actual APR or an introductory 0% interest period. In summary, the American Express Corporate Purchasing Card is a powerful specialized tool for consolidating business spending and tightening procurement controls. It excels at increasing process efficiency and providing deep data insights for auditing. However, the risks should not be ignored. The potential for heavy late fees at 2.99% and the lack of a revolving balance option mean a company must have very stable cash flow. The high costs of international transactions and the administrative effort required for setup are also significant factors. It is a sophisticated financial instrument that requires careful management to ensure the benefits of the 51-day float and merchant blocking outweigh the corporate liability and lack of rewards.